Roger is catching up with Mitch and says, "So I've run my business in a trust and I have $1 million in profit, which I want to distribute to a company. But you said that's subject to Division 7A, and I don't want to use a complying loan agreement. So what's this subtrust arrangement that I keep hearing about?" Mitch goes, "A subtrust arrangement is like a trust within a trust. Instead of the trust paying the unpaid present entitlement owed to the corporate beneficiary, the trust sets aside the money owed to the company in a subtrust, which is only for the benefit of the company." The tax office has provided 3 options of subtrust arrangements. Number 1 is the simplest, and it's basically the trust having a 7-year interest-only loan arrangement with the company at the Div 7A benchmark interest rate. Option 2 is pretty much the same as option 1, but it's a 10-year interest-only loan arrangement at a higher interest rate. Number 3 is the trust holding an asset under the subtrust and paying the income generated from the asset to the company. Roger goes, "Wow, 7-year interest-only option. That's way better than the Div 7A complying loan agreement. So what happens at the end of 7 years? I have to pay back the entire principal?" Mitch goes, "Yes, the trust will need to repay the whole thing." Roger goes, "But how will the ATO know? And what if the trust doesn't repay the whole thing? It's outside the 4-year amendment period. Unlike the Div 7A complying loan, you told me that it's the shortfall of the yearly minimum repayment that becomes a deemed dividend." Mitch goes, "That's a very good point, Roger. Glad you're paying attention." The ATO says, though, if the trust never had the intention to repay the principal when the arrangement was entered into, then the administration concessions should never have applied and may be considered a sham or fraud and evasion, and they can go back beyond the standard period of review and deem that the dividend has arose in the year of the UPE, like 7 years ago. Roger goes, "Yikes, they can do that?" "Yeah, technically they could." Roger goes, "Okay, how about instead of paying off the principal, can I then enter into a Div 7A loan agreement?" Mitch says, "I knew you'd ask that question." And the answer is most likely yes, but it's not a 100% sure thing. It's a long story. So if you entered into a 7-year interest-only loan back in, say, 2010 when all this first came out, then yes, the ATO allows you to convert it to a Div 7A complying loan at the end of the 7 years and get another 7 years, but on principal and interest terms. Effectively, this would have given the trust 14 years to repay the UPE, and all this is outlined in a practice statement by the tax office. And the tax office has been updating this practice statement every year since 2017. So every year they add an extra year to it. So the practice statement now applies to subtrusts maturing in 2017, 2018, 2019, and 2020. Roger goes, "Oh, but what about UPEs created now? And what if I have no intention to repay the principal after 7 years because, I'm banking on another concession from the tax office? How bizarre is this? Why wouldn't the same rules apply to all subtrust arrangements?" Mitch goes, "Yeah, it's quite bizarre. And there's a lot of history behind this. So it all started back around Christmas 2009, where the ATO snuck in a draft ruling, which is now known as Tax Ruling 2010/3, which basically says that from now on, all UPEs owing to corporate beneficiaries are subject to Div 7A because the company not calling for its UPE to be paid is effectively the company providing financial accommodation and is thus a loan under Div 7A. This doesn't apply to UPEs before the draft ruling release, and so those are frozen. And not everyone was pleased about this. In fact, it caused a massive uproar in the market, and many practitioners did not believe that the interpretation was supported by the legislation. Then a few months later, the ATO released a practice statement to provide a bit of an administrative concession on UPEs, which is when they came up with the 7 and 10-year interest-only options. Roger goes, "Thanks for the history lesson, mate, but what should I do?" Mitch goes, "Okay, so the bottom line is this. You can enter into a subtrust arrangement now, but make sure you keep an eye on when it's maturing and make sure you have a plan to repay it when the time comes. But you know what? The entire Div 7A is getting rewritten anyway. It's overdue already, it's been deferred twice, and all UPEs will very likely be brought into Div 7A officially. So all subtrust arrangements will likely be subject to some sort of transitional arrangement." Roger goes, "What? Wait a minute, you said new rules are coming in? What they're going to look like, and how will UPEs be affected?" Mitch goes, "That's a story for another day, mate." Well, I hope you've enjoyed watching this tax nugget. Look out for the next videos on the proposed Div 7A rewrite. Until next week, bye.